welcome to Talk Tickers. Today we're digging into something pretty wild happening with Triumph Financial's fourth quarter earnings. You see, they absolutely crushed their numbers, but the stock, well, it took a nosedive. What gives? Let's unpack this classic case of a beat and retreat.
Okay, so just how good were the numbers? We're talking a complete blowout. GAAP EPS landed at 77 cents. The street was looking for 30 cents. Yeah, that's a beat of more than 150%. Just wow.
So you'd think the stock would rocket, right? Well, it did for a minute. After a quick pop in the pre-market, it completely reversed course and finished the day down over 7%. So what in the world happened? Let's get into it. This, my friends, is what we call a beat and retreat. It's where the market basically says, nice numbers, but we don't believe the story. So we're going to do two things. First, we'll look at the bull case, the story management is telling. Then we'll flip it and look at the bear case that seems to have spooked traders. All right, first up, the bull case. This is all about management's harvest story. And their narrative is actually super clear. They're telling everyone, hey, we spent years building this massive must-have payments network for the freight industry. And now it's time to start reaping the rewards. And you know what? They're absolutely executing on this. We're talking about signing giants like J.B. Hunt. They've got 8 of the top 10 freight brokers, 67 of the top 100. What this shows you is they're hitting a critical mass. This isn't just a small player anymore. They are building a network that's becoming totally essential to the industry. It's that network effect in action. And that density, that network effect, it's translating directly into cold, hard cash. Look at this. The percentage of payments they're actually charging a fee on, what they call their penetration, jumped from 31% to 35% in just one quarter. They even hit 38% in December alone. This right here is the harvest they've been talking about. And this quote from the CEO, it just lays the whole vision out there. He's talking about the core payments business getting to 30% EBITDA margins on its way to 50% or more. You know what that sounds like? That sounds like a software company, not a bank. They're trying to tell the market, hey, stop thinking of us as a boring old bank. We are a high-margin fintech platform. So they backed it all up with really solid guidance for 2026. You've got strong revenue growth, a clear path to higher earnings, and they're even cutting costs. So you have this really powerful story, great execution, strong guidance, which brings us back to the big question, why on earth did the stock sell off? Okay, let's flip the coin and look at the bear case. It seems like the market's skepticism really boils down to two big things. First up, the big picture, the macro environment. And here's the thing, management themselves are saying they don't expect any help from the overall freight market in 2026. In fact, they called the trucking industry a historically bad recession. So they're promising to grow in a market that's basically going nowhere. For a lot of traders, that's a really tough pill to swallow. Second, and this is a bit more nuanced, is the cost of growth. Remember those awesome software-like margins we talked about? Well, that's for the core payments business. When you factor in their big strategic investment, a platform called LoadPay, the picture changes. LoadPay is dragging down the overall profitability, basically cutting the reported segment margin in half for now. It's an investment in the future, but it hurts the numbers today. So here's the bottom line for the bears. You've got this great network story on one side, but on the other, you have a really tough freight market with no tailwinds, and you have these big investments that are muddying the profit picture. And there's one more thing. That huge earnings beat, it seems it was helped by some non-recurring items. So traders are looking at all this and asking, what's the real sustainable earning power here? Okay, so how do we square this circle? How do we reconcile these two completely different takes on the same company? It really comes down to this. Is Triumph a high-growth tech network, or is it just another cyclical bank tied to the trucking industry? So for next quarter, Q1, here's our take. We think they're going to beat their payments revenue guide, but honestly, the most important number to watch, the real proof point, is that core payments EBITDA margin. They guided to over 30% excluding LoadPay. We think they're going to hit it. And if they do, that's the key catalyst. It proves their story is real, and the bull case suddenly looks a whole lot stronger. Because of that, our official 12-month rating on the stock is outperform. We think the market is getting this wrong. They're pricing Triumph like a boring old cyclical company, when the reality is there's a high-margin, high-growth fintech network story here that's really just getting started. To us, this sell-off feels like a huge overreaction and a real opportunity. All right, that brings us to the fun part, the trade idea. How can you actually play this? This is our kind of crazy, but totally plausible way to think about it. Okay, here's the thesis. Right now, TFIN is getting lumped in with regional banks. It's being priced like one. But as they keep proving out those high margins, we believe a re-rating is going to happen. The market will wake up and start valuing it like the fintech company it is. So the trade is designed to capture that exact moment. You go long TFIN and you short the regional bank ETF, KRE. You're not just betting on Triumph to go up, you're betting on it to decouple from the banks and outperform them. And of course, we have to end with this, a quick but very important reminder that this is not financial advice.